So what's the deal with Bitcoin? Is it really the digital gold everyone talks about? A safe place to park your money? Or is it something else entirely? Maybe more like a high-stakes bet on financial chaos? Well, that's exactly what we're going to dig into.
To really get why something like Bitcoin even exists, you first have to wrap your head around a pretty wild idea about the money in your wallet. It is literally designed to lose value over time. So let's talk about why our system works that way and how Bitcoin offers a pretty radical alternative.
And yeah, to do that, we've got to take a quick trip back in time, because the rules that run our money today, they're actually surprisingly new. And figuring out how we got here is the key to understanding what Bitcoin is even trying to do.
Okay, so for decades after World War II, money was what you'd call hard. The US dollar was tied directly to gold. There was a physical limit on how much money could be created. But then, in 1971, everything changed. That link to gold, it was completely severed. And just like that, we entered the age of fiat money. Now, fiat is just a fancy way of saying money has value because a government says it does, not because it's backed by a shiny metal. This gave central banks a kind of superpower. They could create money pretty much out of thin air. They do this through policies with big names like quantitative easing or QE. And boy, have they used that power, especially since 2020.
It was in direct response to that system, this world of potentially unlimited money printing, that Bitcoin was born.
Right, so picture this. It's 2009. The world is still reeling from the 2008 financial meltdown. And out of nowhere, this mysterious person or group, Satoshi Nakamoto, drops Bitcoin on the world. The whole idea was to create a new kind of money, one where the rules couldn't be changed by governments or banks. It was meant to be a system that ran all on its own.
And at the very heart of that system is this one number. Seriously, if you remember nothing else, remember this: 21 million. That is it. That's the absolute maximum number of Bitcoins that will ever exist. The end.
This makes Bitcoin what's known as a hard-capped asset. So unlike the US dollar or the euro or any other government currency that can be printed over and over again, Bitcoin's supply is set in stone. It's totally finite. And that, right there, is the core of the whole digital gold argument. You've got this elastic, unlimited government money on one side and this fixed, provably scarce digital money on the other.
But, a great idea is one thing. The real world is another. So, does Bitcoin's actual performance live up to this grand promise of being digital gold? Let's really look at the evidence.
All right, let's put these two head to head. With Bitcoin, its scarcity is programmatic. It's written in the code. Gold scarcity is physical. We literally have to pull it out of the ground, and that's slow work. But then you look at the other stuff. Gold's got thousands of years of history behind it. Bitcoin, barely 15. And that leads us to the biggest, most glaring difference of all: volatility. And this quote from Bankrate really hits the nail on the head. History matters. I mean, an asset that's supposed to store your value, to keep it safe, you'd expect it to be pretty stable, right? Well, Bitcoin's short life has been anything but stable.
Just think about this for a second. A real store of value probably shouldn't shoot up almost 6,000% in 1 year and then turn around and lose over 60% the next, or jump 1,300% only to crater by 73%. This isn't stability, folks. This is a financial roller coaster, plain and simple. In fact, if you look at the big crashes, from the peak all the way down to the bottom, the numbers are even crazier. Bitcoin has, on multiple occasions, lost more than 75% of its value. This wild, unpredictable price swing is, without a doubt, the single biggest challenge to that digital gold story.
Okay, so based on volatility alone, the digital gold idea looks pretty shaky. But what if we're looking at this all wrong? What if we look at the data through a totally different lens? What if Bitcoin isn't hedging against slow, steady inflation, but against something else entirely? So let's ask a really specific question. When the government comes out and announces the latest inflation numbers, how does Bitcoin actually react in that moment? Does its price pop, proving it's an inflation hedge, or does it just not care? And this is where it gets really interesting. The research shows that Bitcoin's reaction isn't really about the inflation number itself. It's all about this surprise. This is what researchers call an inflation surprise. It's the difference between what all the Wall Street analysts and economists thought inflation was going to be and what the number actually came out as. It's the shock value, not the number itself, that seems to matter. So what did they find? Well, when there's a positive inflation surprise, meaning inflation came in hotter than expected, Bitcoin's price tends to jump.
So it does act as a hedge, but specifically against unexpected inflation shocks. Now, there are a couple of important footnotes here. This effect is context-specific. It's much stronger for CPI surprises than for other data. And interestingly, this hedging ability seems to be diminishing over time. Why? Maybe because as big institutions get involved, Bitcoin starts acting more like a traditional asset, like a tech stock.
Okay, so all of this data really forces us to rethink things. Bitcoin isn't digital gold in that classic, stable, safe haven sense. It's something new. And here's the key takeaway, the big idea. Bitcoin is not a stable hedge against that slow, predictable inflation that eats away at your savings. Instead, it seems to be an episodic hedge. It's a tool that works against sudden inflation shocks. And this actually fits a pattern we've seen play out in big crises. Here's how it goes. Step 1, the shock. When panic hits the market, like in March 2020 or during the big rate hikes in 2022, Bitcoin often gets hammered right along with everything else. But then comes step 2, the policy response. After the shock, when central banks step in with the big guns, massive money printing, quantitative easing, that's when Bitcoin has historically performed incredibly well. So maybe this is a much better way to think about it. It's less like a safe haven and more like a high beta bet on future mistakes. It's a supercharged gamble that whenever there's a crisis, the policy response will be to open the floodgates of money printing, and that Bitcoin will be one of the biggest winners when that happens.
And that leaves us with one last question to chew on. In a world that feels more uncertain by the day, where economic surprises seem to be the new normal, which is actually more valuable? An asset that's designed to be stable through it all, or one that's designed to react to the surprise itself?